Ladies and gentlemen, welcome to the last session of the IFX Expo Asia 2022, the trader mind versus trader in times of uncertainty. The past couple of years have challenged our routines, behaviors, and decisions. This not only affects the state of local and global economies, but also mindsets of traders and investors. This insightful panel of leading professionals will discuss trader psychology and behavior analysis in conjunction with the latest developments in tech and AI. Please welcome on stage Kaia-Reet Parv, Chief Investment Officer at CrediLinq.Ai, who will introduce the panel.
Hello, everyone. Thank you so much for coming. Congratulations to IFX for another successful event. It's my third expo. It keeps getting better every year. We have the honor and pleasure to close the speaker hall events. And we have an amazing panel. And we're going to be talking about fascinating topic, in my opinion, which is trader mind versus technology in times of uncertainty. Before we get into the questions, I'm going to give each panelist opportunity to talk about themselves first and about their company. So we're going to start here. Jerome, please.
Thank you very much, Kaia. Hello, everyone. So my name is Jerome Favresse. I'm what we call a markets veteran. I used to work 20 years on trading floors for top-tier banks, doing strategies. And today, I'm the CEO and the architect for Trading Central, which is a company which is 23-ish years old. And we are providing insights on stuff like fundamentals, technical analysis, news sentiments, and macroeconomics. We serve 200 trading clients worldwide and roughly 80 million of provisions traders around the world.
Hi, I'm Joe Neighbour from Signal Centre, one of the directors at the company, and we focus, like Jerome, on trading tools and insights, providing analysis using technical analysis primarily, but also supported by artificial intelligence, creating unique insights for traders to help them on their journey to become more profitable, work with brokers to help them on the retention, engagement, and acquisition side of things as well.
Aziz?
Good evening, everyone. My name is Aziz Kenjaev. I'm a business manager at BingX, crypto social trading platform and exchange. We provide spot derivative trading alongside with copy trading and algo trading.
Hello, everyone. My name is Dor. I'm one of the co-founders at Dash Analytics. So we are focused on actually helping traders and investors understand and of course, with insights and deep analysis, either fundamental, technical, news, events of stocks, forex, and any kind of instruments in any language. So deep analysis in native languages of any instrument. So, yeah.
Thank you so much. So we're going to start talking a bit about the markets and macro. 2022 has been a challenging year for traders as well as investors. Has been a lot of uncertainty, a lot of volatility in the markets. Just a couple of days ago, we had US CPI coming out. The dollar, I think, skyrocketed 1.17% intraday. So what are your observations of the markets? Is there anything that sticks out based on your analysis? Anything you would like to highlight to the audience here? Jerome?
Yeah. You nearly answered the question. It's a classic cycle, goes up, goes down, nothing is different here. But what is really amazing this time is the volatility we are seeing in the market. You see on whatever asset classes, some massive moves. And even sometimes for stocks, you're seeing some drops of 10, 15, 20% in a single day. And it's completely offset over the last 2 or 3 days. And it's absolutely fine. So it's kind of a different one. Still remains a very bumpy market as usual. But that's really strikes me today is really this volatility we are seeing, those very small flash crash that we observe over not necessarily few years now, but it does exist, and it's something we haven't seen over the 10 years before that. It's very different.
So this time it's different, yeah? It's a famous verse.
Well, we always say it's different.
Okay, so Jerome mentions volatility is different. What about you, Joe? Anything that stands out for you?
Yeah, so obviously markets are exceptionally jittery at the minute. All asset classes are very challenging. I don't think there's anything out there particularly that offers a huge amount of stability to investors at the moment. Obviously the US dollar is pretty much the number one asset class at the moment. I think what stands out to me at the minute is probably more to do with the sort of lack of institutional money that seems to be in the market at the moment. I think when you're seeing the moves that we are in the market, the big moves are on the downside and they're being accompanied by quite large volumes, which suggests that the big footprint, the institutional guys are getting out or moving more into safer haven assets. I mean, we're looking at the bonds at the minute, 2-year US bonds, nearly 4% return. At some point, we're going to look at that and think, well, why would I even bother risking my assets in the market when I can go for government debt that's pretty much risk-free? So it's a challenging time. And I think the last 10 years, obviously there's been an explosion of more retail money coming to the market. They won't have experienced what we're going through now. They will be hoping that the Federal Reserve comes to the rescue, props it all up, and relying on hope as a strategy. And sadly, I think they're in for a really, really tough time. Interest rates going up, cost of living crisis. It's going to be a bumpy ride, I think, from here.
No, it's an interesting, I think, lesson for the whole generation, those who weren't around before 2008 crisis, right? You can actually earn yield on cash. The fact that 2-year note is currently 2.4%, I haven't checked the markets today, that's quite remarkable, right? Because being European, I'm used to seeing a negative number in front of, pretty much all cash rates and including the pension plans. Like mom has to allocate money to government bonds and you just see red number there all the time. So it's an interesting change. Aziz, what about you? Any observations from you?
I'd say we've been in this uncertainty for a longer time than 2022, right? We've been since 2020 and 2019. But relatively, what is related to crypto market, I can speak about crypto market right now, and it was very volatile. And we, as an exchange, saw a lot of retail traders struggling in this market. Because when some things were obvious, in crypto industry, there are a lot of different tools to track, but they're absolutely different, right? There is no one systematic feature that could help a retail trader to trace and to analyze all or make, like 80 to 100% decision. And we saw a struggle in retail traders. We are tending to, we saw this volatility and are tending into going into algorithmic trading rather than giving these retail traders a chance to do their trades on their own, because most of them are enthusiastic, very enthusiastic, Bitcoin maximalist, and all these crypto retail traders, all they want to see is the green bar, is when it's going up, when Bitcoin 100,000, they're maximalists. So we've seen a lot of struggle, but we've been in this uncertainty for a longer time. But I think, as my colleagues mentioned, it's cyclic. It's not something absolutely unusual, or it's something that is called a crash or something. I truly believe that it's cyclic. It's a downtrend as a correction for a shorter time. It's not going to last for long.
Thank you. Dor, what about you?
So I'll connect to what Joe said a few seconds ago, and I truly believe that, of course, we are all aware of the macro events that really affect what is happening in the market. Of course, the Ukraine-Russia war, the situation there, China, Taiwan, situation as well. Of course, the rate hikes and inflation all over the world. And as Joe said, I'd say the Gen Z retail investors has less experience in that kind of uncertain markets. You know, we all know what happened in 2020, where we had that pretty quick, I would say, correction in the market in March, and then of course the H2 in 2020, which was bullish, you know, and everyone in the retail Gen Z thought it may happen again. So we are now facing, I would say, a more uncertain time, but I truly believe in the long term that period of time would help those kind of investors gain the experience they need to have, again, facing, because again, we will go through that time, and in the long term it will help them be more smart, more educated about their positions. So in the long term, without giving an investment advice, I think the worst is behind us, because the market knows how to adapt to the new reality, and I hope the macro events will also become better on all aspects. So I hope the worst is behind, and the green bars will come soon.
Yeah, nothing gives better lessons than losing money, right? As a trader and as well as an investor. So the war was mentioned by Dor, which is interesting because I just had a bit of a recollection. The last time I was on stage with IFX actually was in Dubai the day the invasion started. So a few months later, and I remember having the debate with the market participants, like, oh, is that going to have volatility? What are the impacts? Here we are 9 months later or 8 months later, and yeah, there's definitely volatility. So Jerome mentioned flash crash, right? Some people on the stage are young enough or old enough to remember that event, which was an interesting one. I wasn't around. I was still in university, I believe, back in the day. But we have seen a lot of volatility in the markets, right? And what do you think has caused such volatility? And have these markets been rational or have they been more emotional? And I'm going to start with Joe this time.
Okay, thank you. So I think there's rational decision-making happening at the top end of the market, because I think, you know, the investment banks, the asset managers, they're very smart, they're well-capitalized, well-resourced, and they have expert minds that understand market cycles and have been there and seen it all before. So I think them not participating as much in the market is probably a reason why we're not seeing any stable trends assert themselves in a lot of asset classes at the moment. So I think without those guys, I don't think we're going to get any rally that's really believable for the time being. So I think they are taking a very, you know, rational approach to the market. But the emotional side, obviously, is what we see from the retail clients, because they don't know how to accept risk. They don't know how to manage risk effectively, and they make very jittery decisions and get in and out of markets very quickly. They take profits that are too small. They let losses run that you know, will end up wiping out their accounts. Yeah. And that is, I think, a bit of a cause for concern. I think in terms of the flash crash, the one that we saw in 2010 obviously was a huge event, but we haven't really seen anything of that magnitude since. I think at the time we were all worried that the algos were going to cause more of that, but it seems to have worked itself out for now. But if we move more to an automated approach with trading, then we may see more people clustered into the same sort of trades if they're using the same sort of approach when it comes to financial markets.
Yeah, and I think these days a lot of the exchanges have introduced different type of solutions to sort of stop the downfall, right? The circuit breakers are in place in most exchanges these days, so avoid situations such as this. Aziz, what about you? What's your view on the volatility? Is this rational or is this predominantly emotional?
It's absolutely rational, but you know, for a lot of retail traders, it was very emotional. This rational of what big funds are doing is very emotional to retail traders. So answering to this question, I cannot add anything more what Jerome said. Absolutely, it's rational.
I mean, being a part-time trader, a hobby trader, I shall call it, one of the biggest lessons is remove yourself from the emotion side when you make decisions, right? Always easier said than done. I mean, if you see your account in the red, it's, I'm going to try to distance myself, doesn't really work. So, Jerome, I think you probably have I would say, the heaviest institutional experience of this panel. So you have gone deep into the markets, being a trading strategist on a trading floor. What do you think of this topic?
Yeah, that's a very good topic, and rightly say so. When it's your money, you're acting less rational sometimes than when you're a trader on an institution where it's not your money, so basically you don't care. So that's pretty fine for them. But I agree with Joe, with the institution, the asset manager, hedge fund guys, they are very rational because they are very well informed as well. So they take these decisions, they know not necessarily when to go in the market, but they are surely better on when to go out, which is surely the most important thing to go there. And that's an element that lacks for the retail investors. And it's interesting because you can see it with simple tools like even Google Trend. Like when the market is right, nobody cares. It's absolutely fine. But when you see some indication where something is going on, suddenly there are some questions. Is it going to have a recession? Is it the end of the world or something like this? And they act completely crazy. Alors, they can act at the individual level, could be rational, but as a crowd or as a herd, it becomes completely insane. But again, there's somewhat nothing new in this sense. Maybe we can find a solution, an answer in the structure of the market itself, not talking necessarily about the crypto world, but if we stick to the equities, it's like also the asset management world has changed from active to passive. And today we have nearly 80% of the asset management being passive. So that kind of changed the cards, how they are dealt in this market.
Yeah, you mentioned Google Trends. My favorite chart, I think, during COVID times was the use of word unprecedented, because it was unprecedented use of the word unprecedented, and Google Trends, the word just skyrocketed, which I found absolutely hilarious. Dor, what about you?
So this time I have to not to agree with my colleagues, because in my opinion and according to our knowledge, because some of our clients are institutional, like banks and hedge funds, and according to our knowledge, these guys, like the more I would say sophisticated and educated clients who have strong theses on the market, on their positions, so they know how to make money and to make profit in any market situation. That's their job, and they have more, I'd say, steady or confident positions and hands in the market. So in my opinion, it's in the equation of rationale versus emotion involved. I think that the volatility is coming from pure or mostly due to emotional fear, shaky hands, shaky positions, mostly derived from retail, again, Gen Z, the newborn investors that, they had the wave of 2019, 2020, 2021, and then when there is less certainty, they don't know how to cope with that. So in my opinion, there's more emotion involved, because if rationale was the cause, it wouldn't be like ups and downs like we saw in the last week and in the last month. It would be more steady, inflows or outflows. So pure emotion.
Okay, so we've heard a mix of opinions, rational versus emotional, but Jerome brings up an interesting point, which is that predominantly the flows these days are automated. ETFs are running markets. Once the selling momentum takes off, generally momentum trading follows suit, right? So what do you think in such scenario whereby one action sort of triggers the next? Should we work towards more automation, and should we replace the human decision making with automated trading? Should we have more algos in the financial markets? I'm going to start with Dor this time.
So I think it must be the combination of the two. Like automation, of course, it has some downsides, of course, upsides. But I think the combination of the human logic, of the strong thesis that you should have as an investor or as a trader, of course, it's important. So, but of course, automation and automated support, I think automation and algorithmic, solutions, technologies can help the investors and traders in their decision making. It shouldn't replace it. Because, again, I can go through the downsides of automation and algos. So it must be the combination of both. Of course, you should know what's the algorithmic tools that you are using, how they think, how they analyze the market, what data they are relying on. So you must understand the underlying technology of it, or the underlying thought process of the technology. So it must be a combination.
Yeah, it's interesting, understanding the underlying technology, right, or what's happening. I mean, again, long-term capital management, who knows that name, right? That was a PhD-run hedge fund. If I'm not mistaken, Black and Scholes were the one who established that, and these guys are also known for coming up with options pricing model. Everything was great with that particular model. I mean, there was super smart guys running the shop. But when volatility sort of spiked on the back of Russian crisis, suddenly the model didn't work anymore. So that's the concern I always find. Like, do the smart guys actually know what's happening under the hood, right? I mean, what if their model becomes so sophisticated? And financial markets, they are a complex system, right? So how do you sort of backstop that? But coming back to the original question, going a bit of a tangent here, Jerome, what's your view on that?
I think before creating artificial intelligence, we were able to create artificial stupidity, for sure. That's no questions asked. Yeah, surely every decision to create an algo was right, but when it comes to man versus machine, let's not forget that the one who built the algo, it's the human decisions behind it. So with some rules that are inserted into it, so obviously it's still somewhat human at some point. It definitely helps, as Dor said, I think, what it's complex when you're a trader is stick to your plan all the time. And despite whatever market conditions, despite that you have some opportunities you want to take, if you don't stick to your game plan, you're pretty much dead. So the automated system would help definitely in that space, but I'm not necessarily sure it's the right solution, because they are all bit nearly on the same logic, and it can create some additional volatility as well. But again, I think if as a human you are you set up your mind rightly, you can really succeed, maybe even better than a machine in a way.
Okay, so I mean, the benefit of the machine is clearly that the rules are predetermined. Of course, there's an element of machine learning, right? So the model sort of adjusts itself. And the basics of trading is that you should know when you exit before you enter the trade. But I think that's always the tricky part. Like, oh, maybe it will turn, and maybe the markets will go differently. Oh, I shouldn't go this way. So I guess hope is the worst investment strategy. I believe you mentioned this during the call, or maybe it was Joe. So actually, coming to Joe, what do you think of this?
So I think automation is obviously here to stay, and it's only going to become more present in markets as time goes on. Obviously, the top end of the market, the institutions, the asset managers, they're fully utilising automation in every sense, whether it be for execution, exit, managing positions, or just purely running algorithmic strategies. But of course, they have risks. They don't work forever. Market cycles come and go, and conditions change. And therefore, the models need to change as well. So bringing that down to the retail trader, as Jerome said, they are likely to concentrate on similar strategies to use automation if they are to take that approach. And I think that can cause potential risks going forward. Where I think automation should be used and promoted by brokers everywhere is on the risk management side of things. I think on the exit of the trade, it's purely unemotional if you have a strategy that just gets you out when things aren't going the way you thought they would. And if you can remove that emotional element from the retail trader, I think they'll become a lot more empowered and more likely to have a successful trading journey. So for me, I think risk management for automated, using automation, I think that is where we're going to see a lot more action in the future.
I'm just going to deviate a bit again, but coming to a topic of volatility, right? Let's say if somebody does set some sort of a stop loss at a certain level, but you experience a lot of market volatility, and if it's a leveraged instrument, let's say you trade options, right? Then within intraday, you can basically stop out from your position, although the thesis could still be correct. The market could go in your direction, but just intraday, maybe on the back of some sort of news cycle or just having market volatility, you could be stopped out. So that's a situation that clearly it's a bit difficult to manage if all your stop losses are pre-programmed.
Yeah, absolutely. I mean, but as Jerome will know as well, as technical analysts, we sit there and look at charts all day long, and we might be right, 9 times out of 10, but we actually might get stopped out of 5 of those trades. It's a game of probability, and if you have a good strategy whereby you're looking to maximize your upside, minimize your downside, if you play that same game over the long term, you're likely to have strong outcomes as a result of that. It's not always about being right, it's about making money when it comes to trading. You don't have to be right every time. You don't even have to be right 50% of the time. You can be right 30% of the time and still be okay.
I like that.
You need to get the timing right.
That's But I love the comment that you don't need to be right, you only want to make money. It's almost like marriage, right? You can choose either you are right or you're happy. So, okay, Aziz, I'll let you speak as well on this one.
Thank you very much. I think automation should be here, and automation should be evolving. But really, algos and these trading bots should not be, they are not 100% consistent. They always change in different markets, right? For a certain market, for sideways market, it could bring like good amount of ROI, but if there is high volatility, if there is a dump, like again on crypto, or a huge pump for somewhere, the strategy or the bot will go crazy. It will start opening positions, and again. Many of these algos, they do not modify your position by placing take profits and stop losses. So a retail trader would be, liquidated in a day or two. So I think automation should be used, but it should be used in a combination of a trader making a decision himself, right? And for a trader to better understand how it works and to better understand the market, he should be tracing where the position was open and look at the chart and try to figure out why did that happen, and try to figure out where he should, based on his knowledge, of course, of technical analysis or fundamentals, where he should put the take profit or stop loss, right? And again, risk management is very important at this point.
Yeah, well, Aziz, coming to your point, right? Every algo is still programmed by a human being, right? So at the end of the day, you will always have some sort of human intervention, quote unquote. I'm just going to tell the audience, if you want to ask questions, feel free to put up your hand at any time. We're more than happy to take questions, just to throw the panelists a bit off from their game, because some of the questions are a bit pre-rehearsed, I shall say. So I'm going to ask, does anyone have any questions at this point? Not yet, okay. We'll have some Q&A time at the end, so everybody has to prepare at least one question. But coming to the downsides of automation, a few things have been mentioned, what could be perceived as potential downside if things go wrong. So what is the downside of automation? What should we be mindful about as market participants, be it an investor, be it trader, sell side, buy side? Joe, I'm going to start with you again.
As you say, we've mentioned a few of them already. The flash crash that we saw in 2010. If there's more algorithmic trading activity in the market, then there is faults that can happen. We can't 100% rely on algorithms as well. There is technological faults that occur. and that can create insurmountable losses for customers if they are not monitoring these systems. And I think ultimately what you'll find with retail clients is they'll continue to look for perfection with automated models, and it doesn't exist because nobody's found the answer to that previously. Markets change all the time, and I think that can lead them down maybe a path of unrealistic expectations, and cause them to lose confidence in markets potentially. I think that would be one point of looking at it. Obviously there'll be other points that these guys I'm sure will raise.
You used an interesting expression during our intro call, which was that the markets are, if I'm not, was it emotional maps of human minds? What do you mean by that?
So market behavior or human behavior is something that we all experience all the time, and we tend to always react to certain things in the same sort of way, which is why we see the cycles in markets occur again and again and again. It is just human psychology. There's books going back thousands of years on, written on it, and some very interesting things that are mentioned, like tulips in Amsterdam, or people are acting in crazy ways, and we see it again and again. And it is, I think, a map of human behaviour. I think that's what we see in markets day to day, and it is a big part. Psychology is a big part of trading.
Okay, so Jerome, as I mentioned before, you've been on trading floors, for a few years. I'm sure the trading floors you were on were fully populated, 50, 60, maybe even 100 people. It was buzzing, and it was just like whatever, alpha heaven, effectively. I've been on a trading floor just a few years ago with Bank of America in Singapore, and I can tell you it was a very quiet, very tamed environment. There was perhaps, I'm going to say 30 traders, and most of them actually were PhDs, right? So again, physics PhDs, and not your typical trader from Wolf of Wall Street movie or anything of that sort. So clearly the market has changed, the industry has changed. Automation is here to stay, but what should we be mindful about?
I join Joe here. What is really important, and what we have seen recently, the fundamental analysis exists since the beginning of time. Technical is the same, economics is the same. What the technology allowed us to do was really be able to start mapping the psychology of the market by analyzing news, tweets, sentiment, all these sort of things. That definitely helps you better time the market. As Joe said, there's a cycle. The cycle is well known, in cycle of investment. So when you start investing, the emotion that is leading is optimism. The market goes up, you express joy, up to euphoria, where you think that you will stop your job and become a hedge fund manager, and that will be fantastic. Then it starts to go down, and people say, well, it's nothing, it's just the fundamentals of the market remains. It's just a small correction, and so on and so forth. But it's a classic one. It was empirical, but now we somewhere with NLP and machine learning and these sort of things, it remains a proxy, but we are kind of able, and I think we are all working on this part of the process. We are kind of able to map where we are in the market, what emotion is leading. Is it fear? Is it joy? Is it anger? And it's not a tool that is necessarily predictive, but at least if you know where you are in the cycle, that means the probability of what's going to happen next is reduced. So it's kind of interesting because it brings something new to the table. It was used massively by hedge fund managers for nearly 10 years now, but it's something that comes for retail, and it's relatively easy to understand, even though there are some specificities around sentiment. But that's something that is that is definitely interesting, and that brings something new to the table today. And thanks to technology in that perspective. So I do believe it's, rather than focusing more on automated stuff, it's like the technology should empower the trader and brings new tools in their decision process.
So you mentioned sort of picking up what is the emotion or what's prevailing in the markets, right? There are many ways how you can measure that, right? I mean, the most typical one probably is to use VIX as the fear indicator, currently at around 26, which is above the 10-year average, tend to be below 20 for the longest time. You have the put-call ratio for options also has blown out, I think, at this point. These can be perceived also as contrarian indicators, right? Maybe now it's a good time to start buying S&P 500, for instance. But I want to challenge you. What is the emotion prevailing in the markets right now? What do you think? What is the word, or what's the emotion you would describe?
Fear.
Fear.
Fear is definitely leading there.
So it's not like not getting desperate yet.
No,
Not
it's not
depressed.
despair. It's not despair. We are not there yet.
Not there yet. See, the institutional guy says not there yet. Aziz, what do you think are the downsides of increased automation?
What I think automation does to a trader is makes him lazy, right? So a trader becomes fully relied on this strategy or a robot, and then financial markets is not the place where you just put in your money and start generating, your profits. It's a complex system. So automation could be used as a supplement, but what I believe is when a trader begins and jumps into the market, he needs to first learn the basics of the market, the basics of the market movement, the theories, and then use automation as a supplement to his knowledge. By saying that, I mean, just like I said before, when a strategy works perfectly at one cycle, makes a trader happy, and then the next time you see that the profits generated are lower because the strategy changed, because the markets has changed, that is when the trader becomes fully emotional, right? And he starts to think about the lost opportunities, and starts to jump into another automated system or starts to open positions himself. That's where traders lose their money and just leave the market. And then in the end, who will be blamed? The bot's creator, the exchange, the broker, the Fed, and the other. But I truly believe that the downside is that the automation makes a retail trader fully relied into it and makes him lazy, which really should not be.
I like the comment that put an algo, start accumulating profits, man. Some of us just accumulate experiences, right, with the red numbers on the panel. Dor, what about you?
So the main problem is, as you said, I think with growing automation, of course, is the dependency that the trader or the investor is having, and that leads to a situation where if the model breaks, what happens then? So that may lead to despair, them leaving the market or them leaving the broker or whatever, and we all don't want it to happen. So I think, as I said before, then that it should be a combination. Like, again, if you understand the underlying thought process of the automated tool, either decision support tool or decision-making tool, you will be able to adapt the model if it breaks, if it goes, not perfect. So once you adapt it, you can keep going. You can make profits in the new cycle that is coming. And then again, it's all about, and you mentioned it also, Kaia, you have to understand the why that model worked, why that position was open. And then you can also place the either stop loss if you think the thesis is no longer relevant, or you cannot bear the loss that you got until that point in time. So again, understanding the why, even in automated strategies, again, either support or decision-making tools, is very important. And I think it's key to success to all of us as service providers, and also in the end of the day, to the traders, to the investors. Understanding the why, especially in these uncertain, turbulent markets, is very important.
Okay. Audience, does anyone have any questions to our panelists about market situation, volatility, automation, technology? There you go.
Elias, I'm managing the partnership department for StoneX Retail. So we are offering to our retail clients on the City Index and Forex.com a tool called Chasing Return and Performance Analytic. To join the comment of Jerome about the emotion, we are testing an integration with Fitbit, which is measuring, the impact of the activities, sleep, heart rates on the trading performances. We're also seeing like brokers like IG or CMC providing like psychological tools or reporting. Do you think brokers, or are we seeing more brokers providing such tool, or do you think it should be the new trend rather than going to the trading social or copy trading, joining Aziz's comment about traders becoming lazy simply by copy trading? So do you think brokers should actually get involved into those psychology or emotional trading to support the new traders?
Who wants to take the question?
Yeah, I agree 100% that it's a hugely overlooked area of the market, particularly in retail trading. Controlling emotion, being able to understand, what it does to you in certain circumstances will be extremely beneficial. And I think it is something that if brokers can offer that, I mean, I'm the idea of monitoring health stats, I'm an absolute geek for it. I love wearing my Garmin all the time and knowing all my stats at any time of the day. And if that has any correlation to my trading, I'd be absolutely fascinated to find out. I think that's a really good point you've made there. And I'd be very keen to see that develop further.
Okay. Anyone else? Jerome? Aziz? Yeah.
No, it's something that has to be in the toolbox of any investors. You shouldn't rely solely on that. Some people did it in the past, and they failed miserably on their hedge fund. But definitely, if it's a combination between your due diligence, fundamental analysis, technical ones, macroeconomics, and this one, because it gives a sense of timing in your investment, that's a different story. It's bringing something new to the table that is definitely valuable for the retail investors.
I would say at the point that I don't think people like to admit they are psychologically, I'd say, affected by the market conditions. So I don't know how effective these kind of tools will be. What I do believe brokers should do is showing the clients, the traders, that they are doing as much as they can to help them become more educated, more aware of the situation in the market, in their positions, etc., etc. Because like post losing trade, it's very hard to I would say convince the trader that something was wrong with them. They always will blame others. So the broker would need to convince or to prepare to that situation by providing them with the best tools, convincing them he provided them with the best tools to be successful in their trades, and because post a losing trade, it will be very hard to convince them.
Aziz, anything from you?
What I really like about the business, the brokerages, and us as exchange we provide is I've seen a lot of examples is that we provide education. First, many brokers, if not all of them, but majority of them, they provide education on the financial markets, and it's a must for every trader because for a broker as well, they generate profits out of commissions, and in the end, if the trader comes in, loses his money, and leaves, what's going to be the profit, right? Yes, the educational part should remain, and the algo trading should be evolving. It is evolving, but it should be evolving more. And what I really like recently is that many, algorithmic bots, they are very flexible. So a user can set up his own, like grids or whatever ups and downs and levels. And it's really cool because it gives a trader a sense of control over that bot and a sense of making the decision himself, right? And it involves him in the market, in the trading. So, and it empowers him to learn more. So that's my comment.
Lovely, thank you so much. We have run out of time, so I thank everyone for coming to hear our panel. Thank you, panelists. It was a great discussion.
Thank you, Kaia.
And again, congratulations, IFX. Thank you, Elisa, for organizing everything for us.